In Chinese culture, the dragon represents good luck and strength. In the last quarter of a century, China has displayed a good deal of both, achieving phenomenal economic growth at 9% per annum on average. Industrial production and construction contribute almost 50% of its GDP alone. But this year, the dragon has been up against an unpredictable foe, declining consumer demand. This has caused a slowdown in the country's manufacturing sector, with its Purchasing Managers' Index contracting for 4 consecutive months, falling to 49.3 in July, below the 50 mark that separates growth from contraction. And as other countries battle inflation, China has, for the first time in over 2 years, seen consumer prices fall.
Sluggish consumer demand has really arisen because during the pandemic, when people were under lockdowns, they didn't have that much financial support from the government. So people are feeling relatively poor at the moment. They feel like they don't have that much in the way of savings. So people aren't quite able to go out and spend.
Consumer prices fell by 0.3% in July year-on-year, with the cost of food, transportation, and household goods all in decline. This may seem like a good thing, but low prices signal desperation among producers trying to lure buyers. The decline of China's behemoth construction industry is also driving deflation. China is the world's largest construction market, but in recent years, it's seen a fall in demand for real estate.
Construction has been slowing down. And part of the reason for construction slowing down is simply a reduction in demand for housing, in part because the government has tried to tamp down on speculation, but also in part because, again, people are feeling less wealthy. And a part of this, for example, is in unemployment. So youth unemployment in China is above 20%, and it has been for a couple of readings now, and it only got worse in the latest reading, which suggests that there's a whole cohort of people that simply aren't employed and therefore simply don't have the financial resources to be able to go out and spend. And these factors are really behind the deflation that we're seeing.
Overseas shipments fell by 14.5% in July, adding more downward pressure on prices as global and domestic consumer demand falls. The Chinese government has acted to stimulate the economy by cutting its main benchmark lending rates by 0.1% in June to 3.55% to encourage consumers. But with confidence at an all-time low, the Chinese dragon has a formidable challenge ahead. Emre Boz, TRT World.
For more on this, we are joined by Rajiv Biswas in Singapore. He is the Asia-Pacific Chief Economist at S&P Global Market Intelligence. Thank you for joining us. So, first of all, why have inflation dynamics been so different in China than the rest of the world, especially post-COVID?
I think what we've seen in China is that inflation pressures have been much more subdued due to a number of factors. What we're seeing at present is that lower food prices and also the recent declines in energy prices since their peaks last year have really contributed to lower input price inflation. And also now what we're seeing is that consumer price inflation has also been trending downwards, and actually the July number showed a slight negative reading. So what we're seeing really is that inflation pressures in China have been relatively subdued, and that's allowed the central bank to do some easing of monetary policy.
Right, we were worried about inflation in China and elsewhere until a few months ago, and now it looks like we have the opposite problem. What are the major risks, domestic risks for China, if China were to fall into a deflationary spiral at this point?
I think one of the big concerns right now in China is about weak demand. The recovery in China has been at a much slower pace than had been expected at the beginning of the year. And because of excess capacity in sectors such as construction, that is putting some downward pressure on inflation. Plus, you have global factors coming into play as well, which is that global commodity prices are weaker because momentum in Europe and US has also been relatively weak. So all of these things are pulling prices lower. But the biggest concern right now is not so much about slightly negative readings on inflation, but that the momentum of domestic demand is weak. And we saw that in the recent trade data when imports fell by 12.5% year on year, which is a sign that domestic demand is not showing sufficient momentum. And that points to the need for more stimulus measures. The recent problems in the property sector that have escalated in recent days with Country Garden are also pointing to a lack of momentum in private sector construction. And that's also a very big concern for the near-term outlook, because in previous years, housing construction was a big contributor to economic growth. So there's a lot of troubling factors right now.
Right.
That consumer demand is not strong enough, housing is weak, and exports are also very weak. So a lot of negatives for the outlook for China.
Right, and problems that have to do with the domestic economy in China. But speaking about the rest of the world, I wonder, can this deflation be exported? And could this be a positive factor for the rest of the world, or not so much anymore, because we've seen inflation coming down in recent months?
Well, I think when we look globally, Chinese inflation or lack of inflation isn't going to be such a big factor when we look at the overall factors that are driving inflation in the US or in the European Union. So I think one of the most important issues is commodity prices, the price of oil. That's very important for many countries around the world, and that's been moving slightly upwards in the recent weeks. So that may be a factor that's, again, starting to add a little bit to inflation. But most important is wages. And wages growth in the US and in Europe has been picking up because of the higher inflation last year, which has pushed up wage settlements. The biggest factor that's continuing to contribute to high inflation pressures in the US and the EU is therefore wages. It's not going to be exported deflation pressures from China, at least not in the near-term outlook.